Hello. St. Louis Fed President James Bullard said yesterday what we've been saying all along. We're going to show you what he's talking about. St. Louis Fed President James Bullard says only one rate hike is needed. It's a repeat of what he said a while back, where he said that perhaps we only need one rate hike over the next 2 years, which goes contrary to the Fed's policy and the other Fed board members that are saying that the Fed will raise rates gradually, consistently over the next 2 years, perhaps a series of 4 to 6 interest rate hikes, which is similar to what they promised for this year that they never delivered on. Now, Bullard said the U.S. is in a high liquidity premium regime in which investors are willing to pay premium prices for safe assets like government debt, like U.S. government debt. This ties into our theory that there's no need to raise interest rates much when other sovereign regimes have interest rates at zero or negative. If the United States merely provides any interest to its bondholders, it's one step ahead of the game, and it does not need to pay 1%, 2%, the quarter percent or half a percent interest rate that the U.S. Interest rates that are the federal funds rates. If they translate into a 1-2% rate on U.S. Treasuries, that's good enough. So there's really no need to raise the Fed funds rate, and there's really no need to have U.S. Treasury bonds with higher interest rates. Now, Bullard has stated a few times in 2016 that the Fed's aggressive interest rate projections strain credibility, and we agree. Now, part of our theory has been that Fed policy is driven in large part to preserve the dollar and demand for U.S. Treasuries. The Fed has a dual mandate set in 1979, where the Fed's powers are expanded by Congress to maximize employment, stabilize prices, and moderate long-term interest rates. And that's three mandates, but they call the dual mandate the first two: to maximize employment and to stabilize prices. There's really not much the Fed can do about employment, so it's kind of ridiculous that they have that mandate. Stabilize prices they can do through monetary policy. But recent Fed policy has had less to do with the economy and more to do with keeping that spread between other sovereigns and the United States interest rates, because the other sovereigns having no or negative interest rates puts a damper on the demand for investors to hold those securities and increases the demand for U.S. Treasuries, which actually have a positive rate of interest. Now, St. Louis Fed president said yesterday that even though the Fed is near its inflation labor market targets, that only one rate hike is needed. And again, that differs from the what I call nonsense that the other Fed officials are talking about, including Janet Yellen, that the Fed is still on this gradual path to normalize interest rates. Well, they raised rates once in 2015. They ended QE at the end of 2014, promising to normalize rates, and by now we were supposed to have six interest rate hikes. We haven't. And all through 2015 they weren't normalizing rates. They just managed to get in one interest rate at the end of the year, and they're still claiming they're normalizing rates. Well, they did one in 2015. They haven't done any in 2016. If they do one this year at the end of the year, I wouldn't say it's a gradual path to normalizing rates if they do one quarter interest rate hike each year. But a review of Fed policy over the past 2 years shows that it's all talk and no action. I call these yak attacks. We've heard so many Fed presidents come out each and every month talking about how they're going to raise rates. Rate hikes are on the table. This month is a live meeting. We may even do two. They continue to talk that they're going to raise rates. And the reason they do that is to make sure that people take them seriously. And it seems to work because the dollar index has risen steadily for the past 2 years on talk of rate hikes that they've never done. And we'll get into how the Fed timed its talking and timed its actions in a way such that when the dollar is very strong, it allows them to do things like QE and lower rates. And when the dollar starts to weaken, they ease off of that and they start talking about stopping QE or increasing interest rates. So it's all designed to keep the dollar in a range and also to get the benefits of what they want to do without going overboard. Now, the Fed has stated that interest rates need to rise, and this is what they've been saying, because QE worked and the economy is recovering, strengthening, it's solid and robust. None of this is true. Because if you look at how the Fed measures the economy, none of the, other than the job market, but let's put that aside. If you just look at the overall economy as measured by GDP, industrial production, and other measures of growth, consumer spending, consumer job wages, the economy is not solid, strengthening, recovering, and robust. And therefore, using Fed logic, because the Fed somehow outwardly states that they need to keep interest rates low when the economy is not doing very well. Not to get into why that's a foolish policy, but if that's what they believe, then there's no reason to talk about raising interest rates. So why do they constantly talk about raising interest rates? Or why have they been talking about raising interest rates for the past 2 years? Now, back in April 2015, we raised the point that perhaps the Fed needs to raise interest rates, or at least talk about raising rates, to combat de-dollarization initiatives. In that April article and podcast, we talked about how the U.S. dollar was damaged by 5 years of QE, that there had been outward statements by the Chinese that they were totally against. They hold $1.234 trillion worth of U.S. treasuries. They did not like the fact that the United States the U.S. Fed was just on a $4 trillion money printing spree, which they felt undermined the value of their treasury securities. So we believed, or we stated back in April 2015, that all this rate hike talk is designed to kind of boost back the dollar, the value of the dollar, which had fallen by the end of QE3. And at the time we said that a drop and we had noted the U.S. Treasury securities held by foreigners had been dropping. This is April 2015. It's dropped even further since then. And we stated at the time the Fed's top allegiances are to its shareholder banks, the U.S. government, and if higher rates are needed to help the U.S. government raise revenue, they will raise rates even if it harms the economy. In June 2015, when many commentators were saying there's no way the Fed can raise rates, the Fed can never raise rates, they won't raise rates, in fact it's impossible to raise rates, many prominent commentators saying that it was all talk, we said the Fed will raise interest rates, this is 2015 in the summer, on the pretext, false narrative that the economy is doing well. And if the data continues to come in negative, the Fed will insist it's transitory and the economy will improve in the second half. We believe that higher interest rates were necessary to promote U.S. Treasury bond sales and a stronger dollar. And that higher interest payments could be covered. And that was another thing that people said was why the Fed couldn't raise rates was not only would it be a disaster for the stock market, but that the U.S. couldn't afford its interest payments. Well, I said they can't afford their interest payments now, so it doesn't really matter if the debt service amount goes higher, because how will they pay the debt service? You just issue more bonds. That's Ponzi 101. In order for a Ponzi scheme to work, you have to continue to attract more capital. Well, how do you attract more capital? Well, if one way is to raise interest rates, well, then you do it. So we thought very firmly in June 2015 that the Fed would raise interest rates at least once, and we thought that that would happen, and eventually it did. Now, they did in December 2015. Now, why did the Fed raise interest rates? We put out a article that day when the Fed raised interest rates. Well, the Fed had projected 4 rate hikes in 2016, and we said the Fed would talk about rate hikes but no way do 4 rate hikes in 2016. So right after the rate hike was done, the Fed was talking about doing more. And they were going to continue to do rate hikes. They were now on their gradual path. And many people at the time said, well, it's one and done, and the Fed's not going to do any more. In fact, the next move is going to be to do a rate cut. Now, we said again at the end of last year that we believe the Fed will continue to push the concept that they're on this rate hike path, data dependent of course, because the economy is improving and job gains will eventually boost consumer spending and inflation. And having gained credibility for raising rates, Ms. Yellen and Fed officials will talk about another rate hike for months and send conflicting signals that they might raise rates, might not raise rates, or might lower rates. Well, that's exactly what's happened all year. They haven't done anything, but they've certainly talked about raising rates. And in fact, they even had to talk about not raising rates or slowing the back in January or February when the stock market crashed. So that prediction, and again, I'm not trying to make predictions. I'm trying to understand and analyze how the Fed acts. And this is exactly how they acted. And so the prediction turned out to be correct, not because it showed any superior foresight. It's because I watch how the Fed acts. And this is exactly how they act. It's talk and no action methodology when they want to pretend to be hawkish. And it's the reverse of that action. It's no talk when they're actually dovish. So for example, the Fed is very clever. If the Fed had said at the beginning and talked about openly what at the beginning of the first QE program that they launched in 2009, that they were going to print over $4 trillion over the next 7 years to buy treasury bonds and worthless mortgage-backed securities, and that they would keep interest rates at zero, and talked openly about it, the dollar would have collapsed. But that's exactly what they did. And the dollar didn't collapse. In fact, it's higher today than it was before they started QE in 2009. So you can see a clear MO that when they want to pretend they're hawkish, they're going to talk. When they want to be dovish, they don't say anything. They keep and then only when it looks like people are catching on that, wow, the Fed is just printing money, they're just lowering rates, they're reckless now, that's when they start talking hawkish to boost back the dollar. Now, at the time, at the end of 2015, I thought the Fed would eventually raise rates and then cut rates and eventually go negative once the economy continued to deteriorate. I no longer think they'll go negative. And the reason I don't think that is, I thought at the time they would go negative provided that all the other central banks were deep into negative territory. So the U.S. Fed would still be ahead of them in that they would only have negative interest rates of a quarter. Other central banks may have negative interest rates of 1%. I think the Fed has done a rethink on that, and they seem to be making more than just noises about buying shares and bonds instead of as their monetary policy, instead of lowering rates further. So what I think they'll do is they probably do another interest rate hike, quarter point. And then if there's a problem, and this came out in August at Jackson Hole with Janet Yellen, she said the Fed should start looking at, like other central banks, we don't want to be behind the curve here, and buying corporate bonds and stocks in order to boost not the economy, but the stock market, which they believe boosts the economy. Now, they'd have to ask for congressional approval to do that, but the current Congress seems to be more than willing to give them whatever power they need. Of course, this may change if Donald Trump comes aboard as president and changes the composition of the Fed. But the current Fed would definitely like to engage in more and expand their toolbox and buy shares and bonds. Now, in May 2016, by that point, the Fed had done nothing. The stock market crashed in January. They backed off their 4 interest rates for the year down to 2. And at that point, a lot of commentators, again, were saying, the Fed's not going to raise rates. The Fed can't raise rates. The Fed will never raise rates. Brexit, the next move is negative. They're going to launch QE. I said the Fed will raise rates if it has to. Protecting the dollar and demand for U.S. Treasury bonds is more important than the Fed's dual mandate of full employment and price stability. It's also more important than funneling favor to its too-big-to-fail banks, shareholders. Because without demand for the dollar and treasuries, the proper functioning of the U.S. economy and its deficit-fueled government become tenuous. So when the Fed's credibility, the dollar, and demand for treasuries are on the line, just talking about a rate hike won't cut it. Now, we mentioned, Bullard even mentioned that twice, I think in June and August or in September, he was saying that the Fed's interest rate projections are very aggressive, and when they keep saying they're going to raise rates, they're going to raise rates, or they might raise rates, or it's appropriate to raise rates, and they don't raise rates, that strains the Fed's credibility. And I agree with that. So, my prediction in May was that the Fed will probably sneak in another quarter point rate hike during the year. Even though at the time in May, it looked like with Brexit coming up and all the global financial uncertainty and the economy not going very far, that the Fed would back off raising rates. But they didn't. They continued to pound the table. Even when it looked like there was no way they were going to raise rates, they had these yak attacks. 6, 7, 8 Fed presidents come out, talk about imminent rate hikes, possible, appropriate, looks like June, looks like July, never stopping. And of course, people fall for it, and they never did it. But they will do it. They'll probably do it in December. And again, we don't buy the argument the Fed can't raise rates because it would increase the debt service to levels that the U.S. couldn't afford. The U.S. can't already afford its annual deficit, accumulated debt, and unfunded liabilities. And the only way it gets paid is by issuing more debt. So the idea that the Fed can't raise interest rates because it would make debt service untenable, it already is. So the only way they can pay it is by getting more people to buy more bonds, and then with the principal, they at least have money to pay the interest. Ponzi 101 says you constantly have to raise more capital however possible, and if raising rates attracts more capital, the operator of a Ponzi scheme is compelled to do it. In June 2016, I'm not going to go through this one, but this is where we made the point that the Fed can be dovish and when the Fed can be hawkish. And it shows that when the Fed is most dovish is when the dollar is the highest. That's when they can launch their programs, QEs. And that when the dollar kind of falls too low, that's when they stop their QEs or they start talking about raising rates. Once the dollar heads back up, that's when they can start talking about being dovish again or saying they're going to lower rates. They're going to do QE or whatever they want to do. So you can see at the end of QE 3 on this chart, this is actually a podcast so you can follow through it. When they ended QE 3, the dollar was low and they talked it right back up, as you can see, into 2015 and 2016. And then when people started to lose confidence that the Fed actually would raise rates, you can see this year it kind of went, the dollar index went down, and now they're talking it back up. This doesn't show it here because this is only through, I think, June or July, but the dollar index is right back up to 100 again on the back of Fed yak attacks saying they're going to raise rates. Now, if they have managed to talk the dollar index up to 100, then the Fed may not have to raise rates in December. They may deem that the dollar index is up high enough. They may talk about doing it, but if they don't do it and they start to lose credibility, maybe they then do and the dollar index falls, maybe they then do the rate hike in January, February, March, whenever the Fed next meetings are in 2017. So my point is they'll do one. It depends on where the dollar index is and whether they have to do it. But if they have to do it, they'll do it. There's nothing stopping the Fed from raising the Fed funds rate a quarter point, especially if they want to make sure the dollar's in the range it needs to be for them to conduct future dovish monetary policy and also to keep the Treasury bond yields positive. Now, in September of 2016, after Jackson Hole, Janet Yellen slipped. And she admitted by accident in a press conference why the Fed won't normalize interest rates. There was a reporter asked Ms. Yellen, given the Fed's own projections, there were low growth over the next 3 years. And but there were inflation projections that were higher. And based on how the Fed thinks, when you have low growth, you're not going to have high inflation. They believe that high inflation causes higher growth, and their model didn't seem to work because they had these low growth projections, but they were including higher inflation rates. And the reason they wanted higher inflation rates was to say, well, because we're going to have higher inflation, we have to have more interest rate hikes to combat that inflation. Now, if you follow that logic, then the reporter says, well, wait a minute, if you've got low growth and high inflation, Why would that warrant such a big increase in interest rates over the next 3 years? And Miss Yellen, she just, well, growth projections, yes, they're low, but we revised them down, and the Fed's fund rate too, and low growth is a concern for policymakers. That doesn't make any sense. Basically, the interest rate projections they made in September for the next 3 years are as false as the ones the Fed made 2 years ago that projected six interest rate hikes by the end of 2016. And I think that James Bullard yesterday confirmed that view. Thanks for listening. Please subscribe to Smaulgld.com to get updates sent directly to your inbox for free. And also, please subscribe to this YouTube channel.